Hello there, finance enthusiasts. Welcome to another episode of Finantax Clips. We're your go-to destination for all things finance, where we break down complex concepts into easily digestible clips. Today we've got a real treat for you as we delve into a topic that piques the curiosity of many, the 7 assets that make people rich. We'll be unearthing the secrets behind these wealth-generating assets and how they continue to shape the fortunes of the affluent. From the power of real estate to the promising prospects of new age investments, we've got it all covered. So whether you're a seasoned investor or a curious novice, there's something for everyone in this episode. If you're not yet part of our community, hit the subscribe button, give us a thumbs up if you like our content, and do share our clips with your friends. In this video, we will delve into the 7 assets that can make you rich. So buckle up and let's embark on this financial journey. Kicking off our list is the ever-popular real estate. Now, if you've ever played a game of Monopoly, you know that the player with the most properties usually walks away with the win, and it's not too far from reality. Real estate is one of the most lucrative assets that you can have in your wealth-building arsenal. Why, you might ask? For starters, real estate provides a steady cash flow. When you invest in rental properties, every month you're collecting rent from your tenants. This creates a steady stream of income that's often more reliable than other types of investments. And the beautiful part, this cash flow tends to rise over time as you increase rents and pay off your mortgage. But that's not all. Real estate also offers some pretty sweet tax advantages. For instance, rental income is not subject to self-employment tax. Additionally, the government offers tax benefits, including depreciation and significantly lower tax rates for long-term profits. This means you can earn and keep more of your hard-earned money. Speaking of earning, let's not forget about appreciation. Over time, the value of real estate often goes up, even with the occasional market downturn. This means that the property you buy today could be worth significantly more in the future. Think about it. Have you ever heard someone say, "I wish I bought that property 20 years ago"? That's the power of appreciation. And if you're worried about the risks, remember that real estate is a tangible asset. Unlike stocks, you can see and touch it. It's not going to disappear overnight. Plus, the demand for property, especially in growing cities, is not going away anytime soon. So, owning a property can be a great wealth-building asset. It's like having a golden goose that lays eggs every month. And who wouldn't want that? Next on our list is the stock market. Often perceived as a roller coaster of ups and downs, the stock market is a platform where you can buy a piece of a company, becoming a part owner, so to speak. This is what we call a stock. And when the company does well, so do you. Your stocks increase in value, and you can sell them for a profit. But it's not all sunshine and rainbows. The stock market can be volatile, with prices fluctuating, sometimes drastically, in a matter of hours. This is where the importance of understanding the market comes into play. It's crucial to make informed decisions based on market trends, company performance, and other economic factors. Now, you might be wondering, how can I generate high returns from stocks? Well, there are a couple of ways. First, there's capital appreciation. This is when the price of the stock you own increases. For instance, let's say you bought a stock for $50, and after a year, it's worth $75. That's a tidy profit of $25 per share. Another way is through dividends. Some companies distribute a portion of their earnings to shareholders. This is typically done on a quarterly basis and is a way for you to earn income even if the stock's price doesn't go up. But remember, stocks are not a get-rich-quick scheme. It takes time, patience, and a keen understanding of the market to reap the benefits. And yes, there's always a risk. The stock market is unpredictable. And while you can make a lot of money, you can also lose a lot. But as they say, no risk, no reward. That's why it's essential to do your homework. Research the companies you're interested in, keep an eye on market trends, and if possible, seek advice from financial professionals. Investing in stocks can be risky, but with risk comes reward. And who knows? With the right strategy and a bit of luck, you might just find yourself on the path to financial prosperity. Third on our list are bonds. A bond, in essence, is a loan that you, as an investor, give to a borrower, be it a government or a corporation. Now, why would anyone want to play the lender? Well, the answer lies in the inherent safety and predictability of bonds. Bonds have often been dubbed as the safe bet in the investment world. They offer a fixed rate of return, and, unless the borrower defaults, you're guaranteed to get your principal back at the maturity date. Plus, you're earning interest along the way. It's like having your cake and eating it too, but with very little risk of indigestion. When you buy a bond, you're essentially signing a contract. The borrower promises to pay you a certain interest rate known as the coupon rate for a specific period. This could be anything from a few months to several decades. And when that period ends, you get your initial investment back. This predictability is what makes bonds an attractive option for many investors. While the stock market can swing wildly from day to day, bonds remain relatively stable. They provide a steady stream of income, which can be especially appealing to those nearing retirement or anyone seeking a lower risk investment. But let's not get carried away. It's important to remember that bonds are not entirely risk-free. There's always the risk that the borrower could default on their payments. However, this risk is typically lower with government bonds, as governments are less likely to default than private corporations. Another potential pitfall is inflation risk. If inflation rises faster than the interest rate on your bond, your returns could be eroded. That's why it's crucial to diversify your portfolio and not put all your eggs into the bond basket. Despite these risks, bonds remain a popular choice for those seeking a relatively safe and steady form of investment. They might not offer the potentially high returns of stocks or real estate, but they do offer a measure of security that those assets can't. Bonds are a great way to preserve capital while still generating income. So if you're looking for a safe bet in the investment world, bonds might just be the ticket. Next up, we have mutual funds. Just imagine, you're at a buffet. Instead of loading your plate with just one type of dish, you try a little bit of everything. That's the beauty of mutual funds. They allow you to invest in a variety of assets all at once, spreading your risk across many different investments. Now let's clarify what we mean by mutual funds. These are investment vehicles managed by professionals that pool together money from a number of investors to purchase a diversified portfolio of stocks, bonds, or other types of assets. The aim? To spread risk and potentially increase returns. Think about it. If you put all your eggs in one basket, any mishap could potentially wipe out all your investments. But by spreading your investment across different sectors, industries, and asset classes, you're essentially cushioning yourself against any potential market downturns. This is the concept of diversification, a fundamental principle in the world of investing. But the benefits of mutual funds don't stop at diversification. There's also the advantage of professional management. These funds are managed by seasoned investment professionals who have the expertise, resources, and time to thoroughly research and manage the portfolio. This can be a huge advantage for those who may not have the time or expertise to manage their own investments. Of course, like any investment, mutual funds come with their own set of risks. The performance of a mutual fund is dependent on the performance of the assets it holds. So if the overall market or a particular sector takes a hit, the value of the mutual fund can drop. But remember, the aim here is to spread risk and potentially increase returns over the long term. In conclusion, mutual funds offer a way for investors to gain exposure to a wide range of assets without having to buy each one individually. They provide diversification and professional management, two key ingredients for a robust investment strategy. So if you're looking to diversify your portfolio and spread your risk, consider mutual funds. Mutual funds can be a great way to spread risk and increase potential returns. Fifth on our list is business ownership. Now this is a vast topic, and it's one that can yield incredibly fruitful results if approached correctly. Owning a business isn't just about being the boss. It's about creating something of value, something that can provide a steady income, tax benefits, and potential for growth. Let's start with the steady income. When you own a business, you're not reliant on an employer for your paycheck. Instead, your income is directly tied to the success of your business. This means that the harder you work and the more successful your business becomes, the more you stand to earn. It's a direct correlation that can be incredibly motivating. Moving on to tax benefits. Owning a business can open up a world of tax advantages that are not available to employees. From deductions for home offices to write-offs for business expenses, these benefits can significantly lower your tax bill, leaving more money in your pocket at the end of the day. Last, but certainly not least, let's talk about the potential for growth. A business is not a stagnant entity. It's a living, breathing thing that can grow and evolve over time. This means that as the owner, you have the potential to increase your income exponentially as your business grows. And if you ever decide to sell, a successful business can fetch a pretty penny, providing a substantial return on your initial investment. But let's not forget, owning a business isn't all rainbows and butterflies. It requires hard work, dedication, and a willingness to take risks. You'll face challenges and obstacles that will test your resolve. But if you're willing to put in the work and remain committed to your vision, the rewards can be immense. So whether you're considering starting a business from scratch or buying an existing one, remember the potential benefits that business ownership can bring. Steady income, tax benefits, potential for growth. These are just a few of the reasons why business ownership is an asset worth considering. Owning a business can be challenging, but it can also be a profitable asset. Next, we have intellectual property. Now, you might be wondering, what exactly is this invisible asset? Well, in the simplest terms, intellectual property, or IP, refers to creations of the mind. These could be inventions, literary and artistic works, symbols, names, images, and designs used in commerce. But how does one make wealth from something so intangible? The key is in understanding the real value of IP. You see, IP is unique, it's original. And in a world where everyone is vying for a piece of the pie, being unique holds tremendous value. Consider the world's most successful companies. What's a common thread? They all own a wealth of intellectual property, from patents and trademarks to copyrights and trade secrets. This IP doesn't just add to their brand value, it also serves as a competitive advantage, creating barriers for competitors and paving the way for market dominance. Now let's talk about how IP generates income. One way is through licensing. Imagine you've created a groundbreaking technology. You can license this technology to other companies, allowing them to use it in exchange for a licensing fee. This way, your invention continues to make money for you, even as you sleep. Another route is to outright sell your IP. This could be a lucrative option if the buyer is willing to pay a premium for your unique creation. However, it's worth noting that once sold, you no longer hold the rights to your creation. So it's a decision that should be made with careful consideration. And let's not forget about royalties. If you've written a book, composed a song, or designed a logo, you could earn a steady stream of income through royalties every time your work is used or sold. In conclusion, intellectual property might not be something you can touch or see, but its potential to generate wealth is undeniable. So the next time you come up with a brilliant idea, remember, intellectual property might be invisible, but its value can be immense. Last, but certainly not least, are digital assets. In this ever-evolving world of finance, the rise of digital assets like cryptocurrencies have opened up a new avenue for investment. This isn't your grandfather's stock market. This is the new age of investment, where assets are not just tangible, but exist in the digital realm. Let's take a closer look. Cryptocurrencies, such as Bitcoin and Ethereum, are decentralized forms of currency, operating independently of a central bank. They allow for peer-to-peer transactions to occur online and offer a level of anonymity not seen with traditional forms of money. Now you might be wondering, what's the big deal? Well, it's all about potential. In the past decade, cryptocurrencies have shown a remarkable potential for growth. Bitcoin, for example, went from being worth less than a penny in 2009 to reaching an all-time high of almost $65,000 in April 2021. This kind of exponential growth is rare in traditional investment avenues, making cryptocurrencies an exciting, albeit risky venture. But it's not just about cryptocurrencies. Other digital assets like non-fungible tokens or NFTs have also made a splash in the investment world. NFTs are unique digital assets like art, music, or even tweets that are bought and sold online, often for hefty sums. Owning an NFT means you have a unique piece of the digital world that no one else can claim. Of course, like all investments, digital assets come with their own set of risks. Market volatility, regulatory uncertainties, and security issues are all things to consider before diving in. It's always a good idea to do your research, understand the market, and perhaps, most importantly, only invest what you can afford to lose. Digital assets might be new to the scene, but they are rapidly becoming a popular investment choice. As we move forward into this digital age, these new forms of investment are likely to become more commonplace, offering unique opportunities for those willing to embrace the new and the unknown. And there we have it, the 7 assets that can make you rich. Let's quickly recap. First, real estate, a tangible asset that appreciates over time and can provide a steady income stream. Second, stocks, shares of ownership in a company that can yield high returns. Third, bonds, the safe bet with predictable returns. Fourth, mutual funds, a diversified investment to hedge against risk. Fifth, business ownership, a route to wealth creation that comes with its unique challenges and rewards. Sixth, intellectual property, the invisible asset that can generate passive income. And last but not least, digital assets, the new age investment that rides on the wave of technological advancement. Remember, building wealth is a journey. It takes time, patience, and smart investments. So, invest wisely and see your wealth grow. Thank you for watching Finantax Clips. Don't forget to like, share, and subscribe for more financial insights. Until next time, stay financially savvy.